Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Paul Kim, CEO and co-founder of Simplified ETFs. Simplified offers 26 ETFs currently traded on the US markets with the $2.4 billion in assets under management. And they offer some very interesting, very specialized strategies, first of their kind ETFs, including many hedge fund-like strategies that were earlier available only to high net worth investors, and they are making those strategies available to individual investors in low cost, liquid, and tax efficient wrapper. Paul, welcome back. Great to have you on the show.
Well, thank you for that warm intro and essentially a plug for our lineup. And that is our mission. We are trying to provide and simplify access into alternatives and give investors more choices. So it's great to be back and thank you for your time.
Sure. So you launched your first ETF in September of 2020. So you are less than 3 years old. So with 26 ETFs and 2.4 billion in assets, I would say your ETFs have been pretty successful. So congratulations on that success.
Thank you. We have a great team, and it's easy when you're selling, into big problems, and that's kind of what we try to do: identify big problems for ETF investors in their portfolio, and try to solve them with novel solutions. Sometimes we hit, sometimes we are off, but at least we make the effort, and it's been a really fun journey so far.
Sure. So I wanted to start with your interest rate hedging ETF. The ticker symbol is PFIX, and all your ETF ticker symbols are very, very interesting. So congratulations on ticker symbols as well. And we saw a rapid rise in interest rates in August, and that is the main reason why stocks struggled earlier this month. And in fact, the yield on the 10-year Treasury note topped 4.33% recently, and that was the highest since 2007. Now, yields have come down a little bit this week. Your ETF, PFIX, that did very well this month in August. It rose more than 13%. So tell us what exactly this ETF does, how it performs, and what kind of investors should hold this ETF.
Sure. So the name is the Simplified Interest Rate Hedge ETF. So it definitely is meant to be a hedge. It's primarily used by at least our current investors as a hedge against duration risk. And it's done that very well. And sort of the rationale behind it is that it's expensive to hedge risks, including duration. But if you could find a relatively cheaper place, a more attractive place to hedge, that dominates more expensive forms of hedging. And the payer swaptions market, which is the bulk of what's being used in this ETF to hedge interest rates, is very efficient. It's institutional. It's tens and hundreds of billions of dollars in trading size and volume. So this is where all the big endowments and institutions go to hedge their interest rate risk. And there's just an opportunity where there's a part of that interest rate environment, the market, where there's an inefficiency, and it's really cheap to hedge interest rates using that part of the market. And so the brainchild is from Harley Bassman. He's also known as the father of the MOVE Index, the convexity maven. And he thought it'd be the best form for long-term investors to hedge interest rate risk, because the carry of that hedge, i.e. the bleed of your premium in these options, is pretty reasonable in that part. And he's been proven right. It's PFIX had almost 100% return as rates skyrocketed in 2022. And then this year it's up again as rates, as you noted, are ticking up. So it's performed that role. It's meant to be a small allocation and really meant to mitigate the duration risk across the portfolio.
Right. Yeah. Thanks for mentioning its performance in 2022. I do remember it was the one of the best performing ETFs of 2022 when stocks and bonds and almost all major asset classes had a terrible performance. Now, as I mentioned earlier, treasury yields have come down a little bit, and that's mainly because of slightly weaker than expected economic data. So probably bad news is good news for stocks again now. So for investors who believe that they might have seen the peak in interest rates, should they hold PFIX now, or should they look at some other of from your ETF lineup?
So how we're seeing larger, more sophisticated investors start to use PFIX is not as a standalone, which is still great as an interest rate hedge, but we're seeing them starting to pair it with some long exposure in the front part of the yield curve, like the 2-year treasury, for example. And if you pair that, you've basically created a steepener. And there's been a lot of headlines about the yield curve inverting and reaching what feels like record inversion levels. And so pairing it with something in the front of the curve allows investors to get a steepener where you're basically saying yield curves will normalize at some point, probably when the Fed starts easing, in the sort of future, that yield curve should steepen again. And owning PFIX combined with a long exposure in the front allows investors to get that exposure, again, using ETFs, which is exciting.
So should investors look at your short-term treasury futures ETF? The ticker symbol is TUA.
Yeah, levered 2-year treasury ETF, but we've seen investors pairing those two. So you're taking a concentrated bet in the front part of the yield curve, which is essentially a view that the Fed is more or less done hiking, and at some point they'll start easing. And then in that situation, a levered 2-year exposure would do very well. It's one of the more responsive parts of the yield curve to Fed policy. And on the other side is something like PFIX, which shorts longer dated treasuries. That combination is effectively a steepener, which is not possible to do for most investors without ISDAs or without taking sort of futures positions. And so we're seeing more advisors and institutions starting to pair that type of trade together.
Very interesting.
Yep.
Now, another area which has seen a lot of interest from investors this year is this options-based ETFs that have very juicy yields. So ETFs like by JP Morgan, they have seen billions in inflows this year and last year as well. In fact, JP is now the largest actively managed ETF with over 29 billion in assets. So most of these options-based income-generating ETFs, they hold a portfolio of stocks and then they try to generate additional income by writing out of the money call options. So Simplified doesn't have those kind of plain vanilla strategies, not exactly plain vanilla, but rather simpler strategies. You offer some ETFs, options-based income-generating ETFs, which have a slightly more complicated strategy. And one of your ETFs that I was looking at, SVOL, that has also seen a lot of interest from investors. So please tell us about this ETF, what exactly it does, and why investors should look at this particular ETF.
Sure. Thank you for that. And I love that you could call ETFs like JETB, right, covered call strategies, vanilla. And I agree. I think more and more advisors and investors are viewing option-based income as a key part of their toolkit. Those type of strategies, when you're selling volatility, that's basically what you're doing when you're selling options. When you're selling volatility, you get an attractive yield. And for the most part, the cost of options are higher than sort of the end result, right? So the implied vol of an option is often higher than a realized. Option makers aren't in the business of selling options to lose money. So that's sort of like, generally a true statement through most market environments. And funds that sell vol get rewarded for that sort of insurance or sort of providing that option market, right? So JEPI's delivered great income and distribution yields. SVOL takes that concept and really just offers a pure short vol exposure. We do a lot of risk management, so the volatility of this strategy is well below that of the S&P 500. It's beating the S&P 500 and all of the other covered call strategies in the ETF world since inception back in sort of May of 2021, and it's delivering about a 16% distribution yield. So it's a novel part of the market.
16%. Wow.
Yeah, 16%. It's a great time to be selling volatility in the terms of getting an attractive yield, and there's a lot of demand for hedging. And there's just a lot of volumes and options, including buying and selling. So I think it's a strategy that's proved itself over a number of market periods, and it's getting a lot of interest as, again, sort of people have looked towards options as a source of attractive income. And we take that same concept and we could bring it to the fixed income market. So our strategy, AGH, AGGH, the Simplified Aggregate Bond ETF, takes that concept, buys basically investment grade fixed income or ETFs, and delivers a 10% yield out of a fixed income portfolio that's beaten its benchmark. And that compares to a 3.5% yield of that index. So options can be powerful. People are used to using it on the equity side, but the fixed income side, I think on a relative basis, is even more attractive.
Excellent. Now, I wanted to move on to another strategy which did very well last year, and it's not doing so well, kind of struggling this year. So I want to talk about managed futures. So as I had mentioned earlier, last year was brutal for stocks, bonds, and almost all other major asset classes. So these managed futures and some other quant investing strategies, they did pretty well last year. In fact, one of the managed futures ETFs, the one by Andrew Beard, DBMF, that was one of the best performing ETFs last year. And you offer a managed futures ETF. The ticker symbol is CTA. Excellent ticker symbol. Again, I don't know how you got that.
Why is that available? Exactly.
Yeah. So CTA generally refers to commodity trading advisors. So those commodity CTAs, they used to follow some trend following strategies, I understand. But I don't think many investors understand these managed futures or CTA strategies properly. So before we discuss why they did so well last year but are not doing so well this year, could you please explain what exactly are CTAs or managed futures and what kind of positions they hold?
Sure. So CTAs are the entities that often offer these strategies. So the managed futures strategies, it really is a category. So you have a lot of different ways of delivering managed futures, but the high level punchline of why people buy managed future strategies is that you're effectively getting access to the trend factor, right? They're often called trend following strategies. They tend to do really well when you have sort of a steady trend in one direction. So managed futures did well in 2022 because they were either short equities, short bonds, or some combination that allowed them to ride a very grinding down market that hurt both bonds and equities, right? And this year, it's less that. The 60-40, both bonds and equities have, for the most part, done better as a whole, although bonds, again, have provided some trends. And if anything, equities are trending up. So I think the main value of managed futures is as a diversification tool. 60-40, why is the 40 in there? People rely on bonds largely for diversification to their equity risk. And managed futures, or the trend factor, is actually another powerful diversifier. And if included in the 60-40 context, it actually diversifies against both bonds and equities. And so the classic 2022 60-40 sell-off, right? Pretty rare, but when it happens, things like trend tend to do well because they're another source of diversifier. So I think they're not quite mainstream yet, but we're seeing growing interest in alts. I would say for the first sort of allocation to an alt strategy, managed futures is an obvious, long-tested, decades-long category of strategies that have added a lot of diversification benefits for investors historically.
So, should these strategies be used mainly as hedging tools in a bear market and not when stocks and bonds are doing well?
We think one framework is instead of a 60-40, the sort of a current version that we would push would be a 40-30-20, where things like a managed future strategy would get put into the alts bucket. I think the alts category for the first time is really accessible in an ETF vehicle. So if you can, because in previous years, right, the average investor or advisor really couldn't access hedge funds or very sort of strategies like managed futures, alt strategies that worked, but they had to sort of buy mutual funds or buy very low octane ETFs that didn't really add a lot of value because of all these regulatory limits. But those regulations have opened up, and now you could often see the same type of strategies in a 40-Act vehicle like an ETF. And I think that's the innovation that's allowed for firms like us to provide these type of strategies. And a 50-30-20 can get to similar financial goals with much lower volatility. And in a market where both bonds and equities sell off, i.e. in an inflationary market, typically having alternatives in there would go a long way to help.
So going back to CTA's performance, I noticed that it launched, I think, in March of 2022, and it had double-digit returns last year. So pretty impressive performance considering how stocks and bonds had plunged last year. So what resulted in its outperformance last year? And this year, I saw that it is down about 3% year to date. So what does the ETF hold currently, which has resulted in its underperformance this year?
So last year is easier to answer. It had a very decent position on in a bond short. It was short 5-year futures, for example. And so as rates rose, it rode that trend of bond selling off. This year, again, no real single trend. We've had multiple ups and downs. What's it holding today? It's holding the same type of contracts. It's mostly in fixed income futures contracts as well as commodity futures. It intentionally does not hold equities because we designed this to be a diversifier to 60-40 portfolios. So we didn't want to double dip on the equity long or short. It looks across a lot of liquid commodity markets that allow to capture various trends, things like gold, things like oil, things like copper. But also agricultural stuff like wheat. And so you're getting true commodity exposures to futures, and you're getting true ability to go long and short bonds through futures as well. And it's run by a sub-advisor named Altus, and they have a long track record of managing these type of strategies. They come out of Goldman Sachs. They were the head guy there was a head trader of metals at Goldman, and they've delivered category, at least within the top quartile of the category performance. It's a short track record, but they have what's unique is that it's a daily rebalancing. So this strategy will pick up trends or reversals in trends faster than most. And again, it's an ETF, so it's very, very convenient.
So another hedge fund-like strategy, which has seen some traction with the investors in recent years, is market-neutral strategy. So market-neutral funds aim to outperform the market, but they hold long and short position, and basically their exposure to market is neutral, as the name suggests. You launched a market-neutral ETF recently. The ticker symbol is EQLS. Please tell us about this ETF and why investors should consider.
Sure. So a couple points about this. The equity long short, in addition to the managed futures, those are sort of two of your largest hedge fund categories. The equity long short, the sort of value there is that, hey, you could get equity-like returns without the being long beta, right? So in a market where it's trading sideways or falling, an equity long short has the potential to sidestep that and still deliver attractive returns. And we've partnered up in this case where we're using Wolf Research total return swaps for both the long and short portfolios. They have a proven track record. They manage tens of billions of dollars for institutions. And this is their first access point inside of an ETF wrapper. So proven sort of manager generating the signals, plus that last leg where the regulatory environment changed in October of 2020. And now things like equity long short, which requires leverage, is one, possible, but two, can be levered enough to be interesting, right? So the old knock on alts for about a decade, liquid alts, was that they're basically expensive T-bills. You would get maybe 100 or 150 basis points on top of cash returns and pay a boatload for them. And they weren't that interesting, and they ate up your portfolio slots, right? That could be better used somewhere else. And the difference now is that with the permissions that the SEC has provided in the use of derivatives, we could put out a strategy like EQLS that has a 200% long exposure and a 200% short, and the volatility is tuned to be around equities. And so you could truly get equity-like returns, hopefully better than equity-like returns in market environments where equities are struggling.
Very interesting. Now, another particular ETF that I'll be keeping an eye on is the Simplify, Volt, Robocard, Disruption, and Tech ETF. The ticker symbol is VCAR there. And it is actually one of your best performing ETFs. This is up about 48% year to date, I noticed, though it hasn't seen a lot of interest from investors, a relatively small fund. And Bloomberg reported yesterday that you will be changing its strategy to amplify exposure to Tesla stock when momentum is on the upswing and decrease exposure when Tesla is trending downwards. So I know that you cannot talk about this particular filing because of the regulatory quiet period, but I was interested in your thoughts in general on single stock ETFs. We know that Tesla-based single stock ETFs have seen a lot of interest from investors because Tesla has its diehard fans and its haters too. Nvidia-based single stock ETFs have also seen some interest because Nvidia's performance this year, but other single stock ETFs have kind of failed to gather assets. So what are your thoughts on single stock based ETFs?
So I think the main use case is, you kind of noted it, it's the very sort of true believers, almost a fanatical belief that there's a disruptor that's gonna significantly appreciate in valuation long term, but it's hard to get the timing right? So I think single stock ETFs offer, especially the levered form, offer a very interesting take. And in a way, they're arbing the option market, right? A lot of these sort of super fans tend to buy call options or use leverage themselves. And the cost of leverage, whether you're using margin, which is expensive and can lead to margin calls, or whether you're buying call options, which embed a lot of premium, right? No one's giving away these upside sort of potential for free. Someone's charging an arm and a leg often on sort of the implied vol of these options. So to be able to get a efficient levered exposure at times that you want, that's basically a use case, and a daily compounding strategy that uses leverage can be much more efficient than buying call options, because you're just paying for the daily leverage and you're paying a swap cost, and that's often much lower than margin rates, as well as much lower than the sort of total cost of owning call options, right? And you got to get perfect timing around call options and things. So these daily sort of leverage strategies can be more efficient during sort of certain time periods. And I think that's really the reason why it's gathered so much assets into the category. It's not for every company, because again, it really makes the most sense for companies that tend to be volatile, tend to appreciate, have a big fan base, and who have a big option user base, right? That's really the opportunity for investors to put this alongside of those other ways of getting leverage and deciding what's more effective and what's better long term.
Very interesting. So Tesla checks all those boxes. The stock is known for its volatility, big swings up and down. It has a big fan base, diehard fans and haters too. And the stock also has a big options user base.
Yeah, very expensive options with a lot of implied volatility, right?
Okay.
Yeah.
Okay. That's all we have time for today. Paul, thank you so much for joining us and congratulations on the success.
Thank you so much, Nina. Appreciate the chance to talk and look forward to our next conversation.
So that was Paul Kim of Simplified ETFs. Let's recap some of the ETF tickers that we discussed today. So we talked about PFIX. It is Simplified Interest Rate Hedge ETF. We talked about CTA. It is the Managed Futures Strategy ETF. We talked about SVOL. It is the ETF with a big, juicy income yield. The Simplify Volatility Premium ETF. We also discussed the Market Neutral ETF. The ticker symbol is EQLS. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.